Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I am Michael Bull. Thank you for being with us. This show is brought to you by Lumet. Check them out if you're looking for financing for multifamily, for senior housing, for student housing, or anything related. Check out Lumet.com. Well, we have a great show for you today, and that's what we're going to talk about. We're going to talk about financing and talk about who is doing lending, what type of lending sources are there out there. What are we seeing for underwriting and rates today? And also for various property types and size deals, who might be good sources for you. Well, please welcome my guest. It's Tom Walsh, and Tom is Senior Vice President with Grandbridge, and it's the division of Truist. Tom, good to see you again. Thanks for joining us.
Nice to be back.
Well, the big question on some people's mind today is anyone doing loans? Anybody doing commercial real estate loans today?
They're getting done. Certainly not at the volume that we might like it to be, but they're getting done. Different lender types are more active than others. On the multifamily side, which you just mentioned earlier, Fannie, Freddie, and HUD are both very actively lending, and all three of them are going to have significant appetites in 2024. So we don't see that slowing down at all. Life insurance industry, most of the life insurance companies are in the market, being judicious and cautious, but in the market actively lending, and we don't anticipate that changing going forward either. In fact, life insurance companies usually ramp up their aggressiveness in the first quarter as they get all their new allocations and start over again. The bank side is where you have seen a lot of caution come into the market. A lot of the banks have slowed down significantly in their lending volume. There are some banks out there that, from a commercial real estate perspective, you might say are out of the market. No one uses that terminology generally, but it's close to that anyway. And banks right now, if banks are going to do loans, they're going to be one of two things. They're either going to be very, very conservative, total no-brainers as far as risk goes, or they're for their best customers. If you're a best-in-class customer of a financial institution, they might find their way to making you a loan. If you're a person walking in off the street, knocking on a door of a bank, I need a loan to buy this building here, that's going to be tough sledding right now.
Yeah, it's interesting you say that, but we just closed a loan on a 90% vacant office building that we listed for a bank. It's foreclosed. And the buyer got a loan on office, 90% vacant. But to your point, they had a really strong business and strong relationship. The lender said, whatever you want.
Yeah.
We got you covered. Yeah. Don't talk to anyone else.
And that's not an uncommon scenario. There are customers out there with relationships with banks that they can walk in and almost get the bank to do whatever they need.
Yeah.
Not everyone has that ability, but there are people out there that do.
Yeah. And let's talk about rates today. What are some of the rates you're seeing loans close at today, and has that changed in the last 30 days?
Rates have come down most definitely over the last 30 days. The 10-year Treasury, which is kind of the benchmark for permanent lending, 10-year Treasury was flirting with 5 not that long ago in October. Recently, it's been down in the 4.30 range. That's a 70 basis point decrease. That's pretty significant. SOFR, which is the prime floating rate lending index, has been pretty steady at that 5.30 rate now for quite a while. And SOFR reacts not directly, but very much along the lines with the Fed in the United States. And so when the Fed moves, SOFR often moves, or actually SOFR often moves in advance of the Fed moving based on the prognostication that they will move. But the Fed has been relatively steady for the last few months, and given that, SOFR has been relatively steady, sitting at that 5.30 rate. On the permanent loan side, spreads, not a lot of spreads out there in the market under 200 right now. There would be some for the right product type, right borrower, right loan metrics. There are some spreads under 200, but I would say the majority of deals seem to be going off in the 200 to 250 range. And so that would be at a 4.30 Treasury. That's between, say, 6.30 and 6.70, 6.75, around there. And that seems to be where a lot of rates are being locked right now. On the agency side, which is obviously multifamily only, there's a fairly big delta as to what a specific deal will get for an interest rate. There are certainly rates in the Fannie Mae, Freddie Mac world that are below 200 over. Probably could get down into the 170s maybe for the right deal, especially if it has a little affordability to it. And 170 today puts you basically right at 6, which is historically not a bad rate at all. But probably your more typical rates on the agency side today are probably in that 200, maybe 200, 210 range or so, which puts you, back into the low to mid 6s, where a lot of transactions are going today. On the floating rate side, really the best spreads that we're seeing out there in the market right now in bank world are really 200, 210 or so. And I would go back not that long ago to tell you that the best bank spreads out there in the market are 140, 150 for the best customers. That seems to not really be in play now. The 190 to 200 kind of seems to be where the best deals are going off. And that's 200 over is 7.3, which in a lot of people's minds, that's pretty high, 7.3. There are, but it goes up from there. There are certainly bank deals getting done at SOFR plus 300, which is 8.3. I think prime, is about 8.5. So when you think of you borrowing at prime, that's a pretty good deal to be able to borrow at prime with a bank. That's 8.5. Prime plus 1 is 9.5. Numbers start to get a little scary when we approach 10. So on the floating rate deals right now, the rates are most certainly higher. What makes floating rate deals appealing to people, though, is you're not committing to a long term on it. And there's a belief out there, and you ask 10 different people, get 10 different answers. But I think it's pretty obvious that the belief is rates sometime in the next 2 or 3 years are coming down. As to how far, how quickly, who knows? But they're coming down. So you do get people that even though the rate when they're doing a loan seems a bit high on the floating rate side, they would rather do a floating rate deal and not commit to a long-term deal.
Yeah. So, well, it's interesting. You mentioned rates at 6 to 7% range. I've been in this business for a very long time, and when I think historically, to me, those seem like pretty normal rates. What do you see when you kind of look at that historically?
I think if you borrow money, and I'll go back to 10 years, which is kind of the benchmark rate, 10-year Treasury rate. For 10 years, if you were able to borrow money in the 5.5 to 6 range, I think that would be pretty good at 47 of the last 50 years, probably. Unfortunately, the years where that would be unusually high, we just had those years. Right. You're coming out of COVID in 2021, 2022, we saw, historically low rates. I mean, SOFR, it was, LIBOR at the beginning of that process, SOFR now was down almost approaching zero, basically, at that point. The 10-year Treasury was down in the mid 100s there, 140, 150 at one point, where we're closing loans. A favorable multifamily or industrial deal in that era could have gone off on a 10-year deal like 275, 280, 290, which were historically ridiculously low rates. And what hurts the market today, I think, is that was only a very, very short time ago. And so it's fresh in our minds, and especially in some borrowers who look at 6.5 and go, my God, I borrowed at 3.5 just a couple of years ago. 6.5 seems crazy high, when it's not really. It's not. I mean, on a historical basis, the rates today, they might be a shade high, but certainly nothing that people would get excited about being high.
Right. What are some time ranges? It seems like back in 2021, you could get a loan closed pretty quickly. What should you think about today?
I mean, we're on, I would say, kind of a conventional schedule right now. In most cases, if you go under application for a loan, whether it be an agency loan or a life insurance company loan, you're looking at usually 60 days to closing from that date, from the date you sign the application. And as to getting to application, that can be anything from a week to a month.
Depending on the borrower.
Yes, the borrower,
And
the complexity of the deal,
Right.
stuff like that.
Yeah.
So it's not taking longer than normal at all.
Yeah.
There was a time, recently when everything was running at 100 miles an hour.
Yeah.
That's not happening now.
Mm-hmm.
There is most lenders, whether it be life insurance companies, banks, agencies, they realize that purchases have time frames that are fixed, and they will roll up their sleeves to get an acquisition deal done as quickly as they have to get it done to meet the borrower's timing on that. I would say refis are going to fall into that 60-day normal period.
Yeah.
There.
Yeah, well, that's fair. And in case you're listening to this, not this week, this is December of 2023, because interest rates could be higher, right? Interest rates could be lower. Things can change pretty quickly, and we're going to do quite a few shows on financing here in 2024, since things are moving so quickly. And Tom, I guess lenders are looking pretty close at debt coverage ratios today, right? Mm-hmm. What have you seen for trends there?
Most loans today are debt cover driven. Mm-hmm. And because of that, the historical idea that you can borrow 75% loan to value on a deal, and you can always get 75, that's kind of the market, that's out the window right now. Debt cover driven deals, depending on the property type, will drive your LTV down into the mid to high 60s. High-end multifamily deal, that if you want to say a deal that would trade at a very aggressive low cap rate, you might drive you down to 50%. Right. You could have a 50% deal with a 1.25 debt cover, which historically we've never had that kind of math, right. But we do have it now. Now we have seen in the last 12 months or so, we have seen at least an upward pressure on cap rates, which would solve that problem a little bit. Yeah. But the upward pressure on cap rates has not even been close to being able to offset where your debt constants are today. It's on a really desirable deal, 1.25 debt cover kind of deal. That's what you can get, whether a bank or a life company. I would tell you that there's still a lot of lenders out there that would prefer to play in the 1.30, 1.35 minimum debt cover. And if you have that lender, you're going to be lucky to get to 60 on loan to value.
Yeah.
But almost every deal that we look at today, loan amount is driven by debt cover, not by value.
Right, that makes sense. And have you seen those debt coverage ratios increase? Are lenders kind of being more conservative?
In some cases, yes. It kind of depends on the type of lender you are. On the Fannie Freddie side, because proceeds were so suppressed by the math of how these deals are working today, we're seeing a lot of 1.25 deals there. There was some talk about some 1.20 type stuff. I would say maybe that started a year ago when rates started taking off or so. We really haven't seen that. Fannie and Freddie Mac have both toyed with 35-year amortizations in order to try to get proceeds up. They both at some times over the last few months have offered 35-year amortizations. But we've not really seen people push to 1.20 as far as debt cover goes. On the life insurance company side, they would really prefer to be playing above 1.25. I would say 1.25 is probably reserved for high quality multifamily deals and maybe high quality industrial deals. They would much rather play in the 1.30 to 1.35 debt cover area. And that's probably been fairly consistent over the last few years. So I wouldn't really call that an increase, but there is a bit of a delta to where like the agencies play in multifamily and where the rest of the world plays on the commercial properties.
Yeah, and that's the agency lending has been great for the multifamily sector, right? And always has, and I guess that's planned, right? We all want housing. So, how about CMBS? Active?
It has been a relatively quiet industry over the last 12 to 18 months. The math on rates has not been very favorable in the CMBS world. It's just that when you compare that to life insurance companies or to the agencies on multifamily, the CMBS rates have been 50, 70 basis points wide of that, which has made it hard for them to transact. The CMBS world, in recognition of the rate environment we're in, have come in with a 5-year product now, which it used to be a straight 10-year deal, knowing that so much of the market is not really anxious to lock in for 10 years at a rate that might start with a 7. They came in with a 5-year product, and in fact, you're seeing securitizations now of nothing but 5-year CMBS loans. They're still out there, still active. It's still a very viable product. It's just kind of hard to get the numbers to work to where a borrower wants to transact. Yeah. A lot of the CMBS stuff being done right now is what we call SASB, which is single asset, single borrower deal. And it could be, the craziest example, they have a $500 million loan on a Manhattan building, where you securitize that one loan, and that's all. Right. Probably, I'm just guessing, but I'd say maybe half of the CMBS transactions going to market right now involve single borrower portfolios or single assets that are huge, that can justify a securitization of a single asset of that kind of size.
Right. Let's talk about the different sectors and property types that some of our listeners and viewers might have. Obviously, multifamily is kind of the agency, that's an easy one, right?
I mean, multifamily and industrial are kind of 1A and 1B in most people's hierarchy. Most lenders don't get enough industrial space, enough industrial collateral. And a lot of that is because a lot of the institutional industrial space is owned by REITs. People, names Duke, Prologis, people like that, that everyone has heard of. And a lot of those companies, they do their financing through corporate finance, not through real estate finance. So you'd be very hard pressed to find a lender out there that would say, yeah, we've got enough industrial in our portfolio.
Right.
Okay. At the same time, with Fannie and Freddie taking such a huge market share on the multifamily side, the rest of the lenders also would tell you we don't have nearly enough multifamily either. So that drives those property types to be very, very highly regarded. That's where you're going to get your most aggressive underwriting. That's where you're going to get your lowest spreads on industrial multifamily. Going down from there, and it's a pretty good step down from there. I would say retail is still in pretty good shape with most people. They're judicious. Everyone would love to get grocer anchored on retail, but there's only so much. There's only so many Kroger and Publix centers out there, or Safeways or Vons, wherever you are in the country. So there's a lot more non-grocer anchored retail than there is grocer anchored retail. Yeah. It's funny, the old fashioned unanchored strip that runs parallel to the road. It's got 6 bays, 8 bays, 10 bays in it, which used to be kind of the redheaded stepchild of, no offense, all right, of retail, all right. That now has been viewed as one of the best properties in retail, because most people, you and I, could come up with the 10 tenants with nails, hair, pizza. It's not that hard to fill 10 bays up in a shopping center. Right. The centers with multiple big boxes in them are tough right now. A lot of the big box tenants are tenants that are more susceptible to internet sales, fighting against them. And obviously, which everyone knows who can drive around, see regional malls are struggling on a national basis. You still have your destination location malls that are doing fine. Yeah. But those tend to be in urban to semi-urban locations. When you get out into the burbs, certainly the far-reaching suburbs, a lot of those malls are really struggling.
Well, if you have a strip center, a smaller strip center, and you need financing, what are the best sources right now?
Most of that stuff would be done with life insurance companies. I mean, if you have a bank relationship and you want to stay kind of short on your duration. That's certainly one of that your bank might be willing to do. But a lot of that stuff gets done with life insurance companies who have more of an appetite for what we call the permanent type, the longer permanent type.
How about small balance type loans on those strip centers?
Small. We have life insurance lenders go down to $1 million.
Oh, okay.
And transact all day long between $1 and $3 million. So, okay. I mean, it's a finite number that plays in that space, but there are multiple people in that space.
Okay. How about financing self-storage today?
Self-storage is a funny thing because it is proven over and over again. If you go back to the Great Recession or the Great Financial Crisis and you go through COVID and all that, it is a very resilient product. And it has performed very, very well. A lot of people love self-storage. There's still people out in lender world that view that as one of the out of the mainstream property types and take a very cautious approach to it. But it's pretty mainstream now, I think. There's a lot of lending sources that like it. It's done fairly well. It's a property that is a fairly simple underwriting deal. It's a T12 underwriting property because of cyclicality. You can't take 6 months and annualize, just like you can't do it like with a hotel. You really need full 1 year spans on self-storage. But you take your T12 there, apply a debt yield to that. Not that hard to come up with a loan amount. But it's a product type that's done very well.
And is that sources best for that or what?
It would still be the life insurance companies, I think, by and large. You'll find some debt funds in that. It is a property, and it's actually, I should mention, it's actually a fairly favorable CMBS property too, because there's no TI and LC costs and reserves in dealing with that, and so it's a property like multifamily is, like hotels are. Self-storage, those are all the property types that don't have tenant improvements and leasing commissions on an ongoing basis. Because of that, you don't deal with the reserves that you deal with in CMBS loans that sometimes make those loans very difficult to stomach.
Right. How about hotels? You mentioned hotels. What's the best source there?
It's tough right now. It's primarily a CMBS product still. You will see the occasional life insurance company deal being done with a hotel. That's usually going to be fairly conservative, and often I would call in one of the major families of brands, be it Marriott, Hilton, IHG, maybe throw Hyatt in there with that too. If you get out of those, a lot of the hotel stuff is still being done with small local community banks, where that owner has a relationship. The large banks right now are, to a large degree, kind of pulling back out of the hotel business. There's still a fair amount of hotel stuff getting done, and it's a funny product type because the hotel industry has done fairly well over the last few. 2020 was a throwaway with COVID. But once you get into 2021 and things started to come back, 2022 is a pretty good year. 2023 has been a better year for a lot of those hotels are performing fairly well right now. But it's a little bit of a guilt by association situation on financing. But there's still ways to do it out there. And I said hotels are a very good CMBS product. And I think a CMBS pool is going to market right now, not unusual today, 25 to 30% of that pool being hotels.
Okay. What about financing for senior housing today?
Senior housing is always challenging. Probably maybe a little more challenging right now than it usually is. Fannie and Freddie and HUD all play in seniors housing. They play in slightly different ways. And their appetite on seniors will kind of ebb and flow a little bit. Where the appetite of the agencies on multifamily seldom varies very much. They are in the market all the time, in business looking for loans. Seniors will ebb and flow a little bit. Right now, seniors is still available, but being underwritten very judiciously. Outside of the agencies, though, there are only a small handful of life insurance companies that will do senior housing. And I'll describe senior housing as something that has services. It's not not a 55 and over apartment project.
Right.
Okay, but it has some level of services.
Right.
Life insurance companies, I think, by and large, under the theory that that's really a business more than it's real estate,
Mm-hmm.
have tended to be very judicious or shy away from that product.
Yeah.
Banks have done over the years a fair amount of senior stuff, as we said at the beginning, though banks are not doing a whole ton of business right now. I think seniors right now is challenging.
Yeah. We just got a couple good quotes on from HUD for senior assisted
Okay.
living projects,
Okay.
and we saw a good bit of those, around the southeast. Well, and here's one that people really need some financing on today as a sector: office.
Oh boy, very difficult for obvious reasons.
Mhm.
Very difficult, and the office problem, if we want to call it that, is going to take several years to manifest itself. A lot of these office buildings have large tenants in them. They might have 5, 7, 10 years remaining on their leases. Their utilization is 50% right now. They're still paying. They're paying the rent because they're a going concern. They can pay the rent, but you want, okay, what happens when that rolls? And that question, what happens when that lease rolls, is the predominant reason that everyone is being super cautious on office. Right now in the lending world, it's easier for the lender to just say no office.
Right. And a lot of them are saying that.
Yes,
right?
yes. It's one of those things that there are stories.
Mhm.
Clearly, there are stories out there that make sense, and that have metrics that would allow you to compete, no matter how bad the office market gets. The metrics of this building, we will compete well with that.
Yeah.
And so you'd say, okay, that's a story that makes sense. We should buy into that as a lender. The problem is, and it's a little bit of loan officer career scenarios, in that if I'm a loan officer, and boy, this office thing, it makes total sense. We're going to do this loan, all right? That deal goes bad in 2027, and someone says, "You did that loan back in 2023. What the heck were you thinking doing an office building loan?" They're not going to be concerned about the metrics and the details of it. Is
Right.
you did an office loan in 2023 that went bad in 2027.
Yeah.
That's a serious black mark
Yeah.
on you. And there's a human aspect to this. These people making decisions, credit decisions, they're people.
Right.
They're not machines.
That's true.
And so they in some ways, either overtly or covertly, they look out for their long-term, salvation themselves. Yeah. So office is just hard. Easier to get office done on a small basis.
Yeah.
There are some of the smaller life insurance companies that, if you have the right story and the right sponsor, will still look at an office building under usually very conservative terms.
Yeah.
But when you get into institutional quality buildings like this building or the other stuff in the Glen Ridge area, that stuff's hard.
Yeah.
Right now.
Well, that's interesting. I think that's what's going to make investing in office in 2024, while it's scary to a lot of buyers, I think a lot of buyers are going to make a ton of money being contrarian investors. And I'm under the thoughts that it's office is going to turn around a lot faster than people think. So it's going to be interesting to see what happens there.
I would hope that you are right.
Well, I'll give you just a quick reason why I think a lot of office is going to be converted to other uses. Self-storage, multifamily, mixed use. Some of it's going to be torn down. I also think new supply is going to stop, and as soon as these buildings that have been underway are finished, there's not going to be much new supply in the market. Markets like Atlanta and the Southeast are going to continue to grow, and I think companies are learning more and more each quarter and each year of that the work from anywhere. The problems with that was cybersecurity, trade secrets, and culture, and turnover, and top line and bottom line. And there was a survey by KPMG where they interviewed CEOs that we covered last week, and the percentage of respondents that said they were going to get their office workers who normally work in the office back in the office in the next 36 months. A year ago it was like 36%, and they doubled this year. So it's like more and more they're understanding that, hey, for the health of their companies and their employees, there's going to be some benefits getting back in the right office, right?
Right.
So I think it's going to be a little bit like, housing. Have people thought about housing in the Great Recession? Right, no one's going to buy a house.
Never going to come back.
Never going to come back. Right? What happened? Retail, right? Retail's been left for dead a few times. Look what happened. So I think it's going to be interesting. I think there's going to be a lot of money. So any of your listeners who believe in that and want to invest in office properties, please call me. We're going to put some people together. I think make a fortune. But
if you go back to the summer of 2020, which is not that long ago, retail was dead and buried.
Yes.
Then it was never coming back. It was never going to be the same. Right. And look at retail. I don't know if thriving is the right word, but it's holding its own, certainly. Yeah. The proliferation of restaurants, both big and small. The younger generations eating out much more than we did at that age has certainly helped all that. But retail has changed, certainly. Yeah. But they have found uses. They have found reasons to be in shopping centers. And I suspect if you went back and looked at what people were saying of it back then, is it 3.5 years ago or so now, that it has not remotely turned out like they thought it would be, or how they predicted it would be. Yeah. Maybe, and maybe you're right. Maybe we get that same benefit with office. We'll keep our fingers crossed.
And to your point, I think office will adjust and change, right? It's going to be healthier. It's going to be more inviting. I mean, I've seen some of these offices where I would fight not to go there as well. But you want me to commute and be in this little dank office? Please don't make me do that.
I mean, certainly the novelty of the work from home situation is wearing off, and both in terms, I think, of management of companies, looking at the benefit of the collaboration of having people all together, and even the positive social aspect of getting people all together, in one spot where you're not isolated in a basement or in a dining room at home at your dining room table. I think they see that, and I also think employees are starting to see that this was not quite their nirvana. It seemed to be in 2020. It was so neat. We'd never done this before. I'm working from home, and isn't this cool? I think that's wearing off with a lot of people that are feeling like, I really kind of like to be in an office with a bunch of people there, and the energy that you have from activity going on around you, which you're not getting sitting at your dining room table.
Yeah, and the separation, right, from home and life. And well, let's talk about the safety of loans that are being done today. I think back in 2007, 2008, selling investment properties that we would forecast exit cap rates, and most times when we're doing this, we're representing the sellers taking these properties to market, and we'd use the same cap rate that they were selling for as an exit cap rate, but we knew good and well with what was going on that there's no way. So, and if you look at loans being done today, it seems to me, and I want your thoughts on this, that this could be some of the best time for lenders to do their safest loans. They have potentially less competition, probably a lower loan to value ratio, maybe borrowers getting in at lower bases, maybe no interest rate risk at maturity. And so it seems to me that this is a good time for lenders to build relationships and really put out some safe loans. Am I wrong?
You're probably not wrong at all, really. But I'll use an example of commercial real estate loans done in 2009. I think if you look back historically, would probably be the safest commercial real estate loans ever done, or at least done in this generation, right? Or so. As far as where the economics of those properties that were collateral, where the economics went during that loan term. 2009, it was not an easy time to get a loan.
Right.
All right. And the lending market can be counterintuitive that way. And I think you're right. I think a market like we're in today is an opportunity. Like I said, we're doing 50% loans, and being considered like a max loan, and we're doing 50% loan to value on that. I think you'd have to be a real contrarian to believe that there is at least not some downward pressure on interest rates. And that's kind of your salvation, really, as far as your exit strategies go. I think the loans today are being very judiciously underwritten, using exit rates, exit cap rates, and whatnot that are very, very safe. Using exit underwriting for debt coverage with rates that are very, very safe. I think will probably end up playing out that those were too conservative, but that's fine. That's fine. Your problem you have in the industry is the opposite of that. It's the loans done in 2021, or 20 and 2021 that were underwritten that really low rate environment where there was no anticipation. I mean, people certainly used exit underwriting that was higher than the rates then, not where rates are now. There, So there are a bunch of deals out there in the market. You'd find them in debt funds. You'd find them in banks that were underwritten at what everyone would have said was prudently at the time. That now the metrics of the permanent market right now, they're just not there. You can't pay them off. We weren't ready for 6.5% interest rates on the back end of that. We might have been ready for 4.5 or 5. We weren't ready for 6.5.
So if you're a lender looking to do safe loans and build great relationships, this seems like an incredible time in the cycle to be doing that. I got a loan on an office building, or had a loan on an office building at that time, and my huge bank said, "Hey, pay us off." And it was at the worst time when you really couldn't get a loan. And I said, "Well, you kind of picked the worst time. This building's in great shape. I have great credit, great income. Why are you doing this?" They said, "Well, it's come from the top. We're mark to market. We want you to pay us off." I said, "Well," and they actually brought their guy out to look at the building. And I said, and asked him, "Why are you doing this?" He said, "Well, it comes from the top and there's nothing we can do." And I said, "You know who you guys use to sell your foreclosed property in Metro Atlanta?" He said, "No." I said, "Well, you use me." So you use my company. So you're going to take my building, and then someone else from your big bank is going to call me to sell it, which is going to be interesting. But they'll bring it up because your bank, Truist, that you're a division of at Grandbridge, came in, and when the market was at the very bottom, and said, "You know what? We're going to build a relationship with Michael Bull." And Truist did a loan for me.
There you go.
And it didn't click any box at the time. But they built a relationship, and I've sent a lot of business. It's so, I think this is a great time for lenders to be out there. And then, do you have any tips for lenders out there today?
Tips for lenders or for dealing with lenders?
Well, let's go with the lender first.
Lenders are captive to the credit environment of their institution. And by and large, credit environments across the board are conservative right now. And as I mentioned earlier, there's some personal risk in being the guy that recognizes the opportunity and says, "We should really do this. This is a good opportunity," which might be counter the market at that time. There's some risk in doing that. I just think lenders should, in your case that you mentioned, look at who you're dealing with. And is this a person and I hate to use to say take a flyer, because you never want to think you're actually, going out on a limb and doing a deal. But is this a person I would want to take a calculated risk with? And if your answer is yes, then give it a shot, because as we experienced in 2009, the market is probably, it's 90% likely to get better, and maybe only 10% likely to get worse. As to when that happens, we don't know when that happens. How fast rates come down,
the bottom or the top.
You can't time that, But it will get better. It always has. It always will.
So don't say no as a lender. Look at opportunities.
Look at the deal. Look at the deal. Look at the deal. Look at and do the deals you're going to do with the people that you trust the most and value the most as your customers.
Good tip. All right, well, let's talk about a borrower that's maybe refinancing or doing an acquisition. Tips for them.
Be early. Today, to do a loan, as far as application to closing, is probably not much different than it's ever been. Finding the loan is a little tougher and maybe a little longer process than it has been. So don't wait too long. Okay, you get out there. I mean, if you've got a maturity coming up and it's 6 months out, start talking. Don't wait to 90 days to start talking. Start talking at 6 months. Try to kind of get a feel for what the market's doing, what segment of the market might be where you might be able to transact, as far as which type of lenders to do it. Understand there are a lot of two things. There are a lot of cash-in refis being done where I can make you that loan, but you're going to have to bring a check to the table to make it work. And there are people doing that. There also your acquisition loans are being done with probably higher levels of equity than we have seen in the last 40 years or so. Not at all unusual to see someone coming to the table with 40% on a deal today. 45%
equals safe loan to me if I'm a lender.
Yeah, if you're a lender, yes. That is commonplace. Large equity checks at closings is a commonplace thing today, and lenders and borrowers. I give borrowers credit, excuse me, because historically, borrowers have always been resistant to that movement to lower loans and higher equity checks. The borrowers seem now today, they're resigned. They know. They're not, they're not stupid people, obviously.
Right.
They know that, you're not, if you ask for 75%, people are going to chuckle. What you do is you ask for 65 and hope that you end up between 55 and 60. But the market knows that today. So it's not shocking anybody today.
How are some of these first mortgage lenders looking at leverage when it comes to mezz lending behind them or seller seconds?
That's an interesting topic. Historically, your institutional lenders have kind of poo-pooed the idea of pref equity or mezzanine behind them. There are people now that have come to the realization that might be a way for me to get out of this deal. Is to, for example, you've got a loan that just can't underwrite right now. It's doing well. The property, it's well leased or whatnot, but just by virtue of the interest rate environment, I can't get to that loan amount. Okay, so would you rather, as a lender, kick the can on that deal? Okay, and you've already acknowledged that today he can't get to that loan amount. Okay, would you rather kick the can, or would you rather say, okay, we're going to lend you this and we're going to let you put X amount of pref equity behind us, secondary to us, and I think it's caused some people that who have historically and almost naturally have been very anti junior financing. I'll throw pref equity into the junior financing mode there, that are taking another look at that and saying, maybe we need to change the way we look at that a little bit. And as you would expect in most markets, there's an opportunity there, and there are people lined up around the block to do pref equity and mezzanine financing, because that whenever there's a void in the market, opportunistic people fill the void, and there's that money out there. But both and what's interesting, if you want to consider them market leaders, both Fannie and Freddie have done deals now with pref equity behind them, which I don't know that 5 years ago we could have done that. But they both, and there are lenders out there who have kind of made it a thing to be able to go behind the agencies with pref equity. So I just kind of think that the lending community, is out of self-preservation, kind of has to look at that and maybe reconsider their hard stances on those.
And then on properties that are selling, and sellers are willing to hold a second to help this borrower get a little better leverage, right? So they can increase their returns. I guess some of these lenders, I think we got a quote on a HUD loan, and they seem to be pretty favorable to a seller second, which would give the buyer a really favorable leverage. It was, Are some more lenders thinking of that on
And
acquisitions?
that's another one that historically have been a no-no. But lenders are relatively smart. They figured out the way to make some of these things work, and that's one of the ways.
Yeah, when you're in the first position, and especially if it's a seller second, maybe is one of your points there. If you're in a primary position, say you got a 50% loan to value, and the seller has a 25% second, that maybe if things go bad, that second mortgage holder comes in and takes this over and pays you.
I mean, that's the theory that has always been in play.
Yeah.
There have been lenders I've known over the last 40 years that would love to have a 5% second behind every one of their deals.
Right.
Because that's another source of repayment.
Right.
Or that's a guy that might step in and take your borrower's place on a deal.
Right.
But I would say more often than not, though, lenders have been anti that. And it's just, proceeds are suppressed in the market right now, and that's another way to get a deal to work.
Yeah. Yeah. All right. Well, excellent. Well, thank you, Tom. Great tips, great information. Thank you for being on the show again.
Always great to be here.
All right. And thank you for joining us around the country. Please let us know what you think. If you've got some good source for funding, let me know. Shoot me an email at michael@bullrealty.com. And if you have a lot of cash, you want to buy office and you're contrarian, reach out to me. But I'll probably get more people reaching out and go, Michael, are you crazy? Why would you be doing office right now? Well, we'll see what happens there. Thank you for joining us. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. And by Lument. For senior housing, healthcare, and multifamily financing, visit lumet.com. For more podcasts and videos, subscribe and visit creshow.com.